Okay, so welcome back to the computer screen. What we're going to do now is we're going to look at how the exogenous analysis looks in its entirety for the Aussie dollar US dollar exchange rate. And we're also going to put our exogenous and endogenous analysis together and link all of this up to end up with a fundamental predisposition on the US dollar, Aussie dollar, and the Aussie dollar US dollar exchange rate. So if you navigate now to the file Aussie dollar US dollar exo score, you'll see here that we have our 4 exogenous drivers and our scorecard for each. So each of our drivers is coming in at a minus number, so deflationary for Australia, and presenting us with a short bias on the Aussie dollar US dollar. Overall, our total scorecard, we do this in a similar way to the endogenous analysis. Our total scorecard is on a scale of -10 to +10 for each individual driver. Therefore, the total scorecard has a full scale of 80 points, with the most negative being -40 and the most positive being +40. Our total score is coming in at -14. So on our overall scale, we have a deflationary number, or mildly deflationary overall for Australia. So a mild short bias or fundamental predisposition of short Aussie dollar US dollar. Now, if we go over to our endogenous driver analysis from earlier on in the video series for the US dollar, as a reminder, we have our scale for the US dollar as a total of 310 points. So in the endo analysis, a full scale of 310 points for the US dollar, with a high on the scale of 160, a low on the scale of -150, and a half scale, so equidistant between the high and the low on our scale, is 5. Our overall score, if you recall, was 36, and we did a lot of qualitative analysis on each areas of our drivers, and we got to the total conclusion that 36 on a sliding scale of -150 to 160 was inflationary overall for the US dollar, and most indicators outside central authority drivers are normal to deflationary. So what happens when we put all of this together? Well, if you go to the download section and you download the spreadsheet Endo Exo Analysis US Dollar Aussie Dollar, we have everything put together here for you, and we'll go through this now and explain how it all works. So what we have here first on the top of the spreadsheet is our endogenous analysis from earlier. So on the left-hand side, we have our familiar scale from the endogenous driver analysis spreadsheet, where we're looking endogenously at the United States with our total full scale of 310 points, of +60 to -150 with a half scale of 5. Our score came in at 36 and gave us a short bias. So our predisposition here is that we believe the US dollar on an absolute basis is losing its purchasing power. Now on the right hand side, we have the same scorecard analysis for Australia in the endogenous analysis, but as you may recall, we haven't done our endogenous analysis for Australia through the video series. That's something that you're going to do in your spare time and apply all the same principles that we applied, getting the data and building the scorecards for the United States and working towards a scorecard for purchasing power for the US dollar you're going to repeat this process for Australia and the Australian dollar. So what we've done here is actually kept the endogenous Australia analysis constant. So we've kept it at 0. Now this obviously may change in the future and may contribute overall positively or negatively to the overall scorecarding system when we take into account the exogenous analysis. But for the purposes of teaching you the whole process and sticking to the principles of not spoon feeding and sticking to the principle of self-starter mentality, we're going to keep the scorecard 0, and therefore endogenously Australia is being kept at a constant rate. So then we move on to the relative situation where we scorecard exogenously, and we're just saying in this overall analysis that endogenously Australia is contributing neither positively or negatively on the scorecard to the overall analysis of Australia. Now, when we move on to the exogenous analysis lower down, what we have here on the right-hand side, our subject was to look at the Australian economy and use the Australian dollar, US dollar, as a proxy for our view on the Australian economy relative to the United States economy. And we have our scale, which we just saw over in the exogenous analysis spreadsheet. We have our scale of plus 40 to minus 40 with our full scale of 80 and our score of minus 14. And that is obviously on the scorecard deflationary for Australia, which by default is giving us a minor short currency bias in the Australian dollar. Now, how do we actually relate this over to the exogenous analysis when we scorecard on the side of the US dollar? Well, the negative contribution scorecards across the same for the US dollar, because if we have a short bias in the Aussie dollar on this side, we have a long bias in the US dollar on this side, because with the dynamic relativity principle, you can't sell Aussie dollar without buying US dollar if you actually sell the Aussie dollar US dollar exchange rate. So we have a long bias on this side if we have a short bias on this side. So through the dynamic relativity principle, if we have a long bias on the side of the United States, by default, because we have a deflationary condition here and short bias in Aussie dollar, US dollar, then this means the long bias is either cancelling out some or all of our previously obtained short bias from our endogenous US analysis. Now let's have a look at this in a bit more detail in terms of the dynamic relativity principle. If we have a deflationary number over here and we have a short bias in Aussie dollar, US dollar, then deflation on the Australian economy side would imply through the dynamic relativity principle that we have inflation in the United States or inflationary conditions. Well, obviously that's not the case. It doesn't mean that if we have deflationary conditions in Australia, that we automatically have inflationary conditions in the United States, and vice versa. If we have inflationary conditions in the Australian economy, it doesn't mean that we have deflationary conditions in the United States. So we don't simply add up our scorecards here and create a total scorecard and add the opposite number to the minus 14 on this side and create a plus 14 on this side, because it doesn't simply imply that we have automatic inflation in the United States. What we do is we actually look academically at a scorecard system where we have an endogenous short bias in the US dollar, and if we have a default long bias, this is actually taking away from the overall short bias when we compare the United States economy through the dynamic relativity principle to the Australian dollar. So we don't simply add up our scorecards and then add the inverse of the deflationary number, because that academically makes no sense. We don't have default inflation in the United States when we have deflation or deflationary conditions on a relative basis in Australia. So our score, most importantly overall, is to see whether this number through the exogenous analysis is either contributing positively to our endogenous score or negatively to our endogenous score on both sides of the coin. So also in Australia, we've kept our endogenous analysis constant, and the exogenous analysis is contributing negatively to our Australian scorecard. So if you want to look at this in this way, excuse the typo there, that should be Aussie dollar, US dollar. If you want to look at it in this way, this is how we can look at it. The Australian dollar, the Australian economy is giving us a negative score, so contributing deflationary overall, so endogenous plus exogenous. And the United States is contributing positively overall because we have an endogenous positive inflationary and we have an exogenous negative that's coming from our dynamic relativity principle that gives us a long bias in the US dollar. And that doesn't mean that this is deflationary or inflationary for the United States. It just means it gives us a long bias that cancels out some or all of the short bias. So we have a positive score here and a negative score here. And that tells us to short Aussie dollar and be long US dollar against it. So short the Australian dollar, US dollar exchange rate. Now, what happens if we stress test this analysis and we end up, for example, on the Australian side, getting a total number through our overall analysis, a total number that's positive? Well, this would mean that we have inflation or inflationary conditions on the side of the Australian economy, and we would end up having a long bias on the Australian dollar, US dollar exchange rate. So we would end up with a short bias on the side of the US dollar. And this number is now contributing positively to the overall analysis on this side. And that doesn't simply mean that we get deflation on this side. What we get is a short bias by default from our analysis of the subject economy, from our analysis of the Australian economy, which gives us a default long bias on the Aussie dollar, US dollar exchange rate through the dynamic relativity principle, but it doesn't mean that we have deflation in the United States, because that depends on many other factors. What we've got is a positive contribution to our overall analysis, meaning we have a short bias, and whether this, our endogenous analysis, is a long or short bias, our dynamic relativity principle means by default that we're going to get a positive score contributing to the overall analysis. So again, we don't just simply add up our scorecards and say this is 56 out of 200. We just say academically that through our dynamic relativity principle, we've contributed positively to our overall analysis, and our short bias is either adding or taking away from our bias over here. And in this instance, it's adding to our overall analysis. So what it would mean here is that if we have a short bias here and a short bias here, then our conviction goes higher. So if you recall earlier that we had a long bias through our exogenous analysis, so by default, through our dynamic relativity principle, we had a short bias in the Aussie dollar US dollar exchange rate, which means a long bias in the US dollar or US economy side, and this took away from our short bias. Well, now this is actually adding to our short bias, which gives us more conviction. We're probably double the amount as convinced as before that we should be short the US dollar, and we should be short the US dollar against the Australian dollar. So if we change this back, we can see the current situation where we've scorecarded endogenously in the United States. Theoretically, we've scorecarded endogenously in Australia, and we're keeping that number constant. And we've scorecarded across our exogenous analysis across the Australian economy and measured this relative to the US economy, and ended up with a short bias in the Australian dollar due to deflation. And this, for the United States, our analysis on the US dollar has given us by default a long bias in the US dollar, and the negative score doesn't impact our scorecard for the United States, in the sense that we're looking to gauge whether inflation or deflation in the United States is occurring, because obviously if deflation occurs in Australia, it doesn't necessarily mean that we get inflation in the United States. What we're simply doing is gauging the contribution through our bias. So we know through our bias that the contribution is negative, and that our long bias is cancelling out some of our short bias that we have from previously, from our endogenous analysis. So what does this whole analysis mean when we look at it all together? Okay, well, it means that on an absolute basis, the US dollar is losing its purchasing power. We know that through our endogenous driver analysis. But on a relative basis, it's gaining purchasing power against the Australian dollar, because the Australian dollar is losing more of its purchasing power than the US dollar. And that's assuming our endogenous analysis is not inflationary. Because if this number was positive or more positive than our exogenous analysis, we would end up with a positive number here. So we have to be a little bit careful with our Aussie dollar extreme deflationary economics, because central authorities will act aggressively here, and we could be predicting inflation very soon and be moving towards a long Aussie dollar US dollar bias. And what we have to understand as well is that the Aussie dollar US dollar exchange rate itself is a leading indicator and is dynamic. So it may have already moved to actually price what is happening here in. So all of the data that we're looking at, for example, is from February 2015 and is reported in February and is January numbers, or reported in March and is February numbers. And if you had a look at the Australian dollar back in January, you will have seen that versus the end of March, that the Aussie dollar US dollar exchange rate was higher. And as the numbers come out, or as the numbers are predicted, the Aussie dollar US dollar exchange rate has been dropping. And we need to be a little bit careful that we're obviously not going out and telling you to either short or go long the Aussie dollar US dollar exchange rate. What we're doing is showing you the process so you know how to apply this dynamically. So if you're constantly updating your spreadsheets, constantly updating your scorecards, you'll be able to understand what to do on the current situation moving forward. So now what you have to do is actually go and update all of the data yourself to current data and scorecard accordingly. So in the background overall, we have US dollar inflationary conditions and loose or easing monetary policy in the United States is going to be required in order to maintain GDP growth, jobs growth, and inflation internally. So if the US dollar goes too high, this could actually pose a deflationary threat to the United States, and central authorities might be required to manage the US dollar lower again. So we know from all of our drivers in endogenous analysis that we end up with inflationary conditions, and that loose or easing monetary policy in the US is required further to maintain GDP growth, jobs, and inflation. So when we do our exogenous analysis against the Australian dollar or against any other currency where we end up with a long bias in the US dollar, at the moment we have to be a bit careful that if the US dollar goes too high in value, that it could be a deflationary threat to the United States, and central authorities will have to get involved to manage the US dollar lower. So what have we ended up with here? Well, we've ended up with a fundamental predisposition on the United States dollar, on the US dollar, that is short on an absolute basis and long relative to the Australian dollar, assuming that the Australian dollar endogenous analysis is constant. So our fundamental predisposition is short Aussie dollar, US dollar. And in the bigger picture, what we're beginning to understand here is the current global macro environment of something you may have heard of, global currency wars. So currencies being managed lower to import inflation through the weak currency and export-led growth. So you can do more reading on that in your spare time. But what we're seeing here is quite typical of what's happening at the moment across the world, which is one of the reasons why we've used this as an example in the video series, because it's a classic case. we have inflationary conditions in the United States, where the United States dollar on an absolute basis is losing purchasing power due to central authority monetary policy. And in the exogenous analysis, we have a long bias for the US dollar against the Australian dollar, because at the moment, the Australian dollar is losing more purchasing power than the United States, as we can see from our academic scoring here. So we can see that if the US dollar actually goes too high, that this could be deflationary for the United States, because all of these endogenous drivers are very tentative right now, as evidenced by the data in our analysis. And the central authorities may have to get involved if the US dollar goes too high relative to other currencies like the Australian dollar, and manage the currency lower. And the currency wars is basically an overall label given to the passing the parcel process. So when one country has a problem with their export-led growth, they have to manage the currency lower against currencies globally. And the US dollar is the benchmark. And when the United States has problems, the United States has to manage its currency lower against all other currencies in the world to get export-led growth as well. So when we use the phrase pass the parcel, it basically means whose turn is it to manage their currency lower, because growth is not coming from the economies themselves structurally. A lot of the growth globally in the United States, Europe, Japan, Australia, Asia is coming from currency management. So this is why we've used this example, because it's a classic case. So in your own time, do further reading on the currency wars and what's been going on over the last 5 years. But right now, we're going to go back to the trading desk and move on to our next video. Okay, so welcome back to the desk. I guess at this stage, I should say you can give yourself a massive pat on the back for actually getting to this point. We've taken in a huge amount of information about the whole systematic process to this point. And if you've got this far, you've done very, very well. If you got this far and understood everything, you've done even better. If you need to go back and look through the videos again, I suggest you do that. You know, that's the beauty of the video series. You can keep going through all of the videos until you get it, and keep going through all of the spreadsheets until you fully understand everything. What did we do there? Well, we basically put together our entire exogenous and endogenous analysis together. And we got our overall score for the Aussie dollar US dollar exchange rate coming in at -14 and contributing negatively to the Aussie side and the US side. And by default, this gives us a short Aussie dollar bias and a long US dollar bias. So basically a short Aussie dollar US dollar bias, or fundamental predisposition of being short the Aussie dollar US dollar exchange rate. Now, this may change over time. You have to continue to add in the numbers, the macro numbers, as they come out on a consistent basis, and you will see the dynamic relativity change, and your endogenous number will change, but probably change by less, because the endogenous numbers they change by less over time because they don't have the dynamic relativity principle. So this is something you have to keep on doing as the macro numbers come out, and just update those spreadsheets. So we mentioned this idea of a fundamental predisposition in our overall systematic process of trade idea generation. What does that actually mean? Well, it means basically at this stage we haven't even looked really at a chart of an exchange rate. We haven't done any technical analysis. We've only looked at macroeconomic fundamentals. And we've got to a point where we've decided that when we look at the US dollar, we have an endogenous short bias. But when we compare the Aussie dollar to the US dollar, we have a long bias in the exogenous analysis, and this contributes negatively to our overall score, but gives us a short Aussie dollar, US dollar exchange rate bias. So that's a fundamental predisposition in that what we want to do fundamentally to get the biggest return on a 1 to 3 month time horizon is to actually be short the Aussie dollar, US dollar exchange rate. So we don't want to have anything from the outside, like technical analysis or any other analysis, basically making us change our mind on this. Because one of the stupidest things in the world you will ever do as a retail trader is do all of your fundamental work and end up with, say, a predisposition to be fundamentally short an asset, and then something changes your mind on the outside and you end up going long, and then the asset actually goes down in price, and then you have to cut the position and you lost money even though you had a fundamental short bias. That's just crazy. Now think about it in the opposite. You end up with a fundamental long bias on an asset, and something changes your mind that's nothing to do with the fundamentals to actually go short, and then you go short and it goes up in price. You've done all the hard work, you've found out all the fundamentals, and then you've decided to go the other way because one indicator that's got nothing to do with fundamentals showed you that you should be short for the next week, and then you shorted it and it went through the roof. Well, again, you've basically lost money and you've gone against all of the hard work that you've done. You've lost money and you've been right. That's crazy. So that's one of the cardinal sins of trading, doing all the fundamental work and then doing the opposite because one indicator that's got nothing to do with fundamentals changed your mind. It's the stupidest thing you'll ever do. So right now, what we've got is, through the idea generation process, a trade idea. And what we've got to understand now is that a trade idea at this stage is just an idea. It's not actually a trade. Because now what we've actually got to do is go and time our entry to get into our fundamental position. So in this situation, we're looking to short the Aussie dollar, US dollar, and now we're looking to cleanse the idea and time it correctly. So, for example, we might look at our next stage, which is our gatekeeping process, and through our timing indicators, realize that our fundamental predisposition might not be the best time to put on. So we wait. It might actually be a really good time to put it on, so we might sell some. And we obviously have to manage our risk after that. So at the moment, this is just a trade idea that we've got through all of our fundamental macro drivers. And right now, it's not a trade. So now you're getting an appreciation of the overall process of how this works. The overall process is to have the fundamental foundation and understanding of the Forex markets. It's to have an idea generation process that is based on macro fundamentals with top-down analysis, and that idea generation process is applied across the tradable set, and this spits out fundamental trade ideas and gives you a predisposition to either be long or short currency pairs within the tradable set. The next step is actually to go and time the trades correctly. So if we realize that our fundamental predisposition on a currency pair, the timing is not great at the moment, we wait. So this is now the whole process. So now we're going to move on to the next stage, the gatekeeping process. Don't forget all of these important principles that we've been through. in the overall idea generation process. The principles of objectivity, the principles of static absolution, the principle of dynamic relativity, the principle of self-starting and getting free information. You know, one reminder here, everything we've looked at so far in the idea generation phase, in the endogenous and exogenous analysis, every single piece of data is free. We got it all off the internet. You don't need to buy any of these softwares. You don't need to concentrate on charts and data within your brokerage platform. We're showing you how to do this all yourself. And this is the whole process that you need to go through. Learn how to do it yourself and apply it to all the currency pairs in the tradable set. So this brings us to the end now of the idea generation phase. You've got to repeat this process for the tradable set, but now we're going to move on to the gatekeeping process and show how you turn this fundamental predisposition, this trade idea, into an actual trade, and it becomes a real position in your brokerage platform, in your trading account. Okay, so let's move on to the next video, and I'll see you on the other side.